Hello friends. Last week we saw about trade confirmations. What are trade confirmations? There are multiple trade confirmations like volume based confirmation, indicators, oscillators, isn't it? But there are significant indicators which you come across in your everyday trading. What are those? MACDs, RSI, stochastic, ADX, etc. How these indicators are constructed? Why should we need to learn about it? What are the interpretation of these indicators? Are we rightly interpreting these indicators? All these are part of trade confirmation. And this video is the continuation of last week video. Part 2 of last week video. Why are we waiting? Without much delay, let's start this week video. Trade confirmations part 2. We discussed about volume in the previous video. Now, what is open interest? How to calculate open interest? Now here I have a simple table. Let us take an example. Say for instance I am an apple farmer. I have a truckload of apple expected next month. So I'm planning to sell. I'm trying to get into a futures contract. Why we get into a futures contract? There are plenty of video in YouTube. You can see what is the significance of futures, but I'll simply explain. I am an apple farmer. Next month I am expecting truckload of apple. This is February month. Next month is March. Spring is about to come. So the yield of apple, more output of apple is expected. So market is expected to get more supply of apple. If there is more supply of apple, price of apple comes down. Right? I know this. So what I'm planning to do is I'm expecting $1,000 for a truckload of apple. Next month, due to more supply, better weather condition, I expect the prices of apple come down below $1,000. So I want to execute a contract. I'm not selling anything. I'm just executing a contract for next month. What is that month? March 2024. Truckload of apple, selling it for $1,000. I'm the seller. There is another side of it. Where there is a buyer. I'm located at Houston. There is a Houston supermarket. That supermarket owner expects that next month there will be a hurricane or cyclone. So it will impact the supply of apple. It will reduce the supply of apple. So he expects truckload of apple price may go upwards, increase. So what he says, he also motivated to get into a contract for $1,000. So I expect price of apple comes down next month. So I get into a contract. He expects that price of apple may go upwards. So he also gets into a contract. We get into an agreement or contract. Truckload of apple for the month of March. I'm supposed to supply to the Houston supermarket owner for $1,000 per load. That is futures contract. Now there is one open interest. Right? Whenever there is one outstanding contract, that is called one open interest. Now, immediately after it enter into a contract, after a week, I expect my assumption was wrong. I also believe that hurricane is about to come, cyclone is about to come. The price of apple may increase. I did a stupid mistake of entering into a contract of $1,000 per truckload of apple. Now, I know my neighbor farmer, right? I'm trying to transfer this contract to my neighbor, which is highlighted in second line. I want to close my contract. I'll transfer it to my neighbor. Buyer is still intact. Houston supermarket owner is still intact. He wants to stick with the contract. I want to sell it to my neighbor farmer. Now, contract is still there. So, there is no change in the open contract, open interest. After a week, the buyer, who is the supermarket owner, he believes that the hurricane took a reverse turn and he's not expecting any hurricane. And he believes that there will be more supply of apple. He did a mistake of getting into a contract. So now he transferred to another supermarket owner. Now he closes his buy side of the contract. Seller is intact. My neighbor farmer is the seller, and the Houston supermarket transferred it to Dallas supermarket owner. Right? No change in open interest. At the end of March, when the contract is to be executed as per the terms, there are three things can happen. Whoever is the active seller or whoever is the active buyer in that point of time supposed to supply truckload of apple for $1,000. When? By the month of March. Either he can supply the truckload of apple or he can pay equivalent cash, $1,000 he can give equivalent cash instead of app, or he can transfer the contract to next subsequent month. From March, the contract can be transferred to next subsequent month. In that case, the contract comes to an end where open interest is zero. While entering into the contract, open interest is added upon. When closing the contract, open interest is reduced. In between, when there is a transfer of contract, there is no change in the open interest. So hope you understand how the open interest is calculated. Now we understood how to calculate open interest, isn't it? Now, how to interpret open interest. If open interest is rising or if open interest is falling, how to interpret the open interest? Let's follow this table. If price is increasing, volume is increasing, open interest is also increasing, then the interpretation is strong bullish trend. Price continue to rise. Price is increasing but volume and open interest is decreasing. In that case, it's a weakness in the uptrend. Moderately bearish. The trend may change direction. Price coming down, volume and open interest is increasing, meaning stronger bearish downward trend. Price is decreasing, volume and open interest is also decreasing, meaning low strength in the bearish market. It is weakness in the downward trend. It's about to change the trend direction. With open interest and price, including volume, this Herrick payoff index is calculated. In the lower portion of the screen, you can see Herrick payoff index. This is an oscillator and solid black line is Herrick payoff index and the gray line is the moving average of Herrick payoff index. What is the interpretation for Herrick payoff index? When the index is above or below zero and whether divergences exist between volume and open interest, then we need to understand the trend accordingly. Trend lines are often informative for warnings of change in price direction, as are the penetration of support and resistance levels. With that, we understood that with the Herrick payoff index, we can use divergences, trend lines, support and resistance as well. There are few more open interest indicators like on balance open interest indicator. This is similar to on balance volume, which we discussed in the previous video, part 1 video. Instead of volume, open interest is used and the calculation and interpretation are similar to on balance volume. Open interest index. This index is calculated similar to the price and volume indicator. However, instead of volume, open interest is used. Next, we are going to discuss about momentum because further special indicators and oscillators will have momentum into consideration. So we should be aware of momentum. What is momentum? It is simple. Rate at which prices are changing. In an uptrend, prices are rising and the trend line slopes upward. Momentum measures how quickly the prices are rising or how the trend line is sloping. Let's see with an example. Suppose the stock is originally selling at $25 a share. If the same stock is selling for $30 a share 5 days later, then the stock price increased for the following 5 days. Momentum would be $5 increase. Initially it was 25. After 5 days it's 30. So the momentum is 5 days it increased. How much is the momentum per day? $1. If over the next 5 days, the price continues to increase. Price is increasing still. However, from 30 it increased to 34 for the next 5 days. Initially, it increased from 25 to 30. $5 increase in 5 days. Per day momentum is $1. However, for the following 5 days, price increased, increased $4 for 5 days, which is less than $1 per day. So this is all about momentum. A peak in momentum, therefore, is not equivalent or leads to a peak in the price. And is this useful a warning of possible peak in the immediate future? Momentum is confirming the price trend. A convergence and confirmation occurs. When momentum fails to confirm the price trend, it gives a divergence. And similarly, confirmation also is used to identify overbought, oversold condition. Using momentum, we can identify overbought, oversold condition. In momentum, this chart is one of the significant chart which we need to understand. In this chart, this is momentum indicator. So momentum indicator. If momentum indicator is rising, what does it mean? Price increasing more rapidly. If momentum is decreasing, if you see the slope down, but it is above zero, right? This line is zero line. Momentum is decreasing, however, above zero, meaning price increases at a slower rate, right? You see the up arrow, you see the down arrow. Up arrow means momentum makes the price increase more rapidly. Down arrow means price increases, however, in a slower rate. Similarly, if this momentum crosses below zero, price decreases more rapidly if the direction is downwards. However, if still the momentum is below zero, but it's rising, meaning price decreasing in a slower rate, the trend may change to upward trend pretty soon. So this chart is pretty important in case of momentum. Normally we used to think like above zero, if momentum comes down, we think like stock market or the particular stock is coming down. No, it's not. It may come down. It may show up some divergence, but not yet. But when it crosses zero, yes, stock price is coming down. Similarly, when we see upward trend, we can consider like, no, now the stock is going upwards. No, if it is upward trend and still the momentum is below the zero line, then the decrease is in the slow rate. Still the decrease is going on, but in the slower rate. Let us discuss about MACD. These are some of the specific indexes and oscillators which we heard about pretty frequently, are common indexes, oscillators we use for trading, isn't it? What does MACD means? Expansion for MACD is moving average, convergence, divergence. That is MACD. MACD is a variation of the moving average crossover. The MACD is calculated using the difference between two exponential moving average. The solid black line you see right in the screen is MACD line. How this MACD line is calculated? This is the difference between 26 period EMA and 12 period EMA. 12 period EMA. What is EMA? Exponential moving average. What is moving average? Refer the past video. You can understand what is moving average. In detail, I explained about moving average and exponential moving average. So MACD, this black line, is the difference between 12 period EMA minus 26 period EMA. This calculation results in a value that oscillates above and below zero. This is the zero line. This line oscillates above and below zero. Positive MACD indicates that the average price during the past 12 period exceeds the average price over the past 26 period. This black line is MACD line. Then what is this dotted line? This dotted line is the signal line. How it is calculated? This is the 9 period exponential moving average of this MACD line. We know what is this black line, of course, MACD line. We know what is this dotted line, which is a signal line. What is this histogram? The histogram is the difference between MACD and the signal line. Now you understand what are the significant attributes of MACD. MACD line, signal line, histogram. Now how can we interpret this MACD? MACD is useful in trending market because it is unbounded. There is no bound for it. It's unbounded. Crude signals occur when the MACD crosses the zero line, but they are the same signals as would be generated from a moving average crossover, similar to that. Buy signals occur when MACD crosses from below to above the signal line. But we should be mindful, there may be some whipsaws. We should look in for some additional confirmation. Downward crossing are not at all reliable while the trend is this downward crossing is not at all reliable when the trend is upward. Divergence analysis works in downward trending market. Divergence is applicable for MACD. You see, this is the positive divergence. Positive, in case of positive divergence, point we need to keep on top of our mind is we should look for troughs, lows, right? Here we see positive divergence, and immediately after the positive divergence, when the MACD line crosses the signal line, similarly we can see upward breakout. Right? This divergence is an indication that there is an upward breakout. And similarly we see a negative divergence. For negative divergence, we'll draw for highs. Right? If you want to understand more about divergence, please refer my previous video. Here immediately after, at the end of the divergence, even the MACD line also cross over the signal line and downward market continued. Even in the price pattern, downward market continued. So this is how we interpret the MACD. More research and analysis are needed. We cannot solely rely on the MACD. MACD is just for confirmation purpose. Rate of change oscillator. It is an oscillator. It is a measure of the amount a security's price has changed over a given number of past period. The formula is, for example, if we are calculating rate of change for 5 period, price 5 period ago is deducted from today's price divided by the price 5 period ago multiplied by 100. Formula is price today minus price n period ago divided by price n period ago multiplied by 100. ROC is 0 if price today is same as it was n period ago. It shows on continuous basis how the current price relates to the past price. ROC suffers from drop-off effect. Why? Because it's not considering previous period price. For example, in our case, if we are taking 5 period price, it's not taking the price 6 period ago, 7 period ago, so on and so forth. So it's impacted by the drop-off effect. How should we interpret the ROC? Its position relative to 0 can indicate the underlying trend. It can be a divergence oscillator. It can be an overbought, oversold indicator. It can generate a signal when it crosses over its zero line. Let's see some of the examples here. Here we see a trend line, downward flowing trend line, and there is a breakout which is supported by price trend. Similarly, we see positive divergence. Number 2. Number 3, we see price patterns. It's small symmetrical triangle and there is a breakout. And number 4, there is a trend line and positive divergence which is broken by the price, confirmed by the price trend. And number 6, again there is a trend line, breakout of the trend line below, confirmed by the price. Number 8, there is a downward flowing trend line and still it to get a breakout. In this example, oversold and overbought conditions are not considered. All these signals supposed to be confirmed by price. Relative Strength Index, RSI. RSI measures the strength of an index against its history of price change by comparing up days to down days. There is an assumption for RSI. Wilder based his index on the assumption that overbought levels generally occur after the market has advanced for a disproportionate number of days. Oversold levels generally follow a significant number of declining days. There is relative strength in the market, which we compare it with the benchmark. This is relative strength index. We should understand the difference between these two. What we are discussing is relative strength index. This is not relative strength. The formula is up days are calculated by calculating sum of gains over n period divided by n. Down days are calculated by sum of losses over n period divided by n. Relative strength is ups divided by downs. RSI equals 100 minus 100 divided by 1 plus RS. So we have the formula, but these days we need not to understand how the calculation happened. We have this RSI inbuilt in many of our trading platforms, so we can leverage that. RSI can change from a low of 0 till 100. Wilder used 14 days as the relevant period, but this is what Wilder used. We can use our own number of days as per our set. How to interpret RSI? When the RSI is above 50, the midpoint of the bounded range, the underlying trend in price is usually upward. Conversely, it is downward when the RSI is below 50. Overbought and oversold warnings are the same. RSI above 70 to indicate an overbought situation and RSI below 30 to indicate an oversold condition. But this levels 70-30, maybe 75-25 or 90-40 in case of upward trend or 60-10 in case of downward trend. RSI divergences with prices often give warnings of trend reversal. RSI also appears to have patterns similar to price charts. We can see triangles, pennants, flags and even head and shoulders patterns. Support and resistance level as well applicable to RSI. Failure swing as well occurs. What is failure swing? A failure swing occurs when the oscillator exceeds an overbought or oversold level, corrects, reverses back toward the overbought or oversold level, doesn't reach it, and then turns back beyond the correction. For more detailed explanation, refer the past video, part 1 video. I explained in detail about failure, swing, correction. So RSI is one of the value add most popular indicator. Stochastic oscillator. Stochastic looks at the most recent close price as a percentage of price range, high minus low, over a specific past window of. Stochastic works better in a trading range market but can still give valuable information in a trending market. In trending market, the divergence in the stochastic trend line breaks and swing failures generate signals. For trading range market, crossovers and swing failures generate signals when the stochastic reaches overbought or oversold levels. Crossovers occur when the fast stochastic crosses over the slow stochastic. Chart patterns such as triangles and pennants can also evolve in stochastic oscillator. All standard technical rules apply to oscillators. However, oscillators by themselves should never be used strictly for signals. The analyst must confirm any oscillator signal with price action, a breakout or a pattern. Formula for stochastic you can see right in the screen. We'll calculate %K, which is close minus low divided by high minus low multiplied by 100, and we calculate fast %D, which is this solid black line, which is 3 bar SMA of %K, which we just calculated, and slow %D is the gray line, which is again 3 bar SMA of %D, %T, this black line. We have %K, refer the formula, fast %D, which is this black line, slow %D, which is this gray line. With this, we'll arrive at the stochastic oscillator and we'll use the stochastic oscillator. Similar to all other interpretations, divergent, trend line, patterns, overbought, oversold, applies to stochastic oscillator as well. We discussed about various confirmation signals. We used volume. Volume is one of the significant confirmation, right? And there we referred multiple indicators and oscillators. Another set of confirmation is momentum, right? And even in momentum, we saw about MACD, RSI, rate of change, stochastic, etc. So these confirmation we cannot completely rely whole and soul. These are in addition to the initial analysis we perform with price. So always in our arsenal, we can have ADX, oscillator and price analysis. One of the oscillator, anything it can be. This will help us to have better trading. This is what we covered in part 1 and part 2. Thank you for your time. Please consider subscribing for my channel. See you in the next video. Bye bye.